Here's something most people never think about. The bank sitting on your street corner might be regulated by a completely different government agency than the bank across the street, even though they both call themselves banks, offer checking accounts, and look identical from the outside. One of them might answer to a federal regulator in Washington, D.C. The other answers to a state banking department you've probably never heard of. And that one choice, made by the bank, not by you, quietly affects your interest rates, your fees, and even how disputes get resolved if something goes wrong. So which type of bank is actually better for you? Stick around, because by the end of this video, you'll never look at a bank's fine print the same way again. Welcome back to Money Regulation Hub, the channel where we break down the hidden rules that shape how money moves in America. Today we're tackling one of the most misunderstood topics in banking: the difference between a national bank charter and a state bank charter. A charter is simply the legal license that allows a bank to exist and operate. Just like a restaurant needs a health permit, a bank needs a charter. But here's the twist. In the United States, banks get to choose whether their permit comes from the federal government or from an individual state. This is called the dual banking system, and it's been around since the 1860s. By the end of this video, you'll understand what a national charter is and who regulates it, what a state charter is and who regulates it, why banks choose one over the other, how this choice actually affects you as a customer, and which type tends to offer better protections. This isn't just trivia. Understanding this system helps you make smarter decisions about where you bank, invest, and even work. Let's get into it. Let's rewind to the 1860s. Before the Civil War, banking in America was chaotic. Each state had its own rules, and thousands of different state banks printed their own paper currency. Some of that currency was worthless outside the state that issued it. Imagine trying to pay for a coffee in New York with money printed in Ohio. Nobody trusted it. To fix this mess, Congress passed the National Bank Act of 1863. This created a brand new option. Banks could now apply for a national charter issued by the federal government, which came with a standardized national currency and federal oversight. But here's the important part. State charters didn't disappear. States kept issuing their own charters too. That's how we ended up with two parallel banking systems running side by side for over 160 years. This dual system is unique to the US. Most countries just have one national regulator. So today, when a bank opens its doors, its founders have a choice to make: go national or stay state chartered. Let's break down what each option actually means. A nationally chartered bank gets its license from a federal agency called the Office of the Comptroller of the Currency, or the OCC. You'll often see the letters NA after a bank's name. That stands for National Association, and it's your clue that the bank is federally chartered. Think of household names like Bank of America, NA, or Wells Fargo Bank, NA. Here's what national charters mean in plain English. One rule book. Nationwide. A national bank follows the same federal rules whether it operates in Texas, California, or Maine. This is huge for big banks that operate across many states, because they don't have to juggle 50 different sets of state regulations. There's also federal preemption. This is a fancy legal term that basically means federal rules can override certain state laws for national banks, particularly around interest rates and lending practices. This is actually why some national banks based in states with no interest rate caps, like South Dakota or Delaware, can charge credit card interest rates that would be illegal for a state-chartered bank in a stricter state to charge. That's part of why so many major credit card companies are headquartered in those specific states, and there's stronger federal oversight. National banks are examined by OCC bank examiners who show up, review loan books, check for risky practices, and make sure the bank isn't taking on more risk than it can handle. For everyday customers, this often means more consistency. If you move from Ohio to Florida and you bank with a national bank, the rules governing your account generally don't change. A state-chartered bank gets its license from an individual state's banking department, for example, the New York State Department of Financial Services or the Texas Department of Banking. These banks don't have NA in their name. Here's the key thing most people don't realize. State banks are typically regulated by two agencies, not just one. The state banking regulator handles the charter itself, but because most state banks also carry FDIC deposit insurance, the FDIC, or for banks that also join the Federal Reserve System, the Federal Reserve acts as an additional federal backstop. So what's the appeal of staying state chartered? There's local flexibility. State regulators often understand the local economy better. A community bank in rural Iowa financing family farms operates very differently from a mega bank in Manhattan, and state regulators can tailor their oversight accordingly. There are also lower compliance costs. For a small community bank, dealing with one state regulator can be simpler and cheaper than federal-level compliance requirements designed with giant banks in mind. And there are closer relationships. Community banks that are state-chartered often pride themselves on knowing their customers personally, the classic your local hometown bank feel. This isn't just marketing. Smaller state banks make up the vast majority of community banks across the U.S. For everyday customers, state banks can sometimes mean more personalized service, but potentially fewer product offerings compared to a national giant. This is where it gets strategic. Banks don't pick a charter randomly, they run the numbers. Size and ambition matter. A bank planning to operate in 20 states will almost always go national. Because dealing with one federal regulator beats dealing with 20 separate state regulators, regulatory cost matters. Believe it or not, banks sometimes switch charters purely because one regulator's fees or examination style is more favorable. This is sometimes called charter shopping. And while it sounds shady, it's completely legal. It's similar to how companies incorporate in Delaware because of favorable corporate law. Interest rate rules matter. As we mentioned earlier, national banks can export the interest rate rules from their home state to customers everywhere, thanks to federal preemption. This is a major reason certain credit card and lending companies specifically chose a national charter based in a state with looser rate caps. Community identity matters too. For a genuinely local bank whose whole brand is "we're part of this town," staying state chartered reinforces that identity and can be a competitive advantage in marketing. Here's a question worth sitting with. When you see a bank advertise itself as locally owned, does that actually mean anything for the safety of your money? The answer is, not really. Deposit insurance coverage through the FDIC applies to both national and state banks equally, up to the standard coverage limit per depositor per bank. So your money is federally protected either way. Let's make this practical. Here's what actually changes based on a bank's charter type. Interest rates on loans and credit cards. As covered above, national banks may be able to charge rates that a state-chartered bank in your state legally couldn't. Where you file a complaint, if you have a dispute with a national bank, your complaint often goes to the OCC or the Consumer Financial Protection Bureau. If you have a dispute with a state bank, it may go to your state's banking regulator instead. Knowing this can save you time when something goes wrong. Product availability. National banks, because of their scale, often roll out newer digital tools, more branch locations, and broader ATM networks. State-chartered community banks may offer more flexible, relationship-based lending, the kind where a loan officer actually reviews your specific situation rather than relying purely on an automated credit score. Deposit safety. As mentioned, this is the same either way, assuming the bank is FDIC insured, and the vast majority of both national and state banks are the bottom line. The charter type isn't something you need to be afraid of, but it explains why two banks offering seemingly identical products can have very different interest rates, fee structures, and complaint processes. Let's bring this all together. A charter is a bank's operating license, and in the US, banks can choose between a federal charter or a state charter. This is called the dual banking system. National banks are regulated by the OCC, follow one uniform federal rulebook, and can benefit from federal preemption of certain state laws, especially around interest rates. State banks are regulated by state banking departments, often paired with FDIC or Federal Reserve oversight, and tend to offer more localized, relationship-driven banking. Banks choose their charter strategically based on size, growth plans, compliance costs, and lending advantages, not out of loyalty to one system or the other. And your deposits are protected either way, as long as the bank is FDIC insured, regardless of which charter it holds. Understanding this helps you read the fine print differently. Next time you see NA after a bank's name, you'll know exactly what that means, and why it might matter for your interest rate. That's the real story behind national versus state bank charters, a distinction that's invisible to most customers but shapes the entire American banking system. If you found this breakdown helpful, do me a favor and hit that like button. It genuinely helps this channel grow. If you're new here, subscribe so you don't miss the rest of our banking regulation series. And I'd love to hear from you. Drop a comment below telling me, do you bank with a national bank or a local community bank? And has this video changed how you think about it? If you know someone who's ever complained about confusing bank fees or asked, why does my bank charge more than my friend's bank? Share this video with them. It might finally answer that question. Coming up next on Money Regulation Hub, we're diving into how the FDIC actually decides how much of your money is protected, and the surprising ways you could accidentally have more money at risk than you think. You won't want to miss that one. See you in the next video.